let's get into corporate actions. What are they and why should we care? A corporate action is an event that's initiated by a publicly traded company, and that event can have a significant impact on, uh, for example, the shares of stock of that company. So a merger or an acquisition, a stock split, again, both forward and reverse, ordinary or non-ordinary dividends. All of these have impacts on the stock of a company, the portfolio that a shareholder is holding. These corporate actions can change the composition of it, right? For example, if you've got company A merges with company B, now you no longer have maybe shares of company B. Those shares are now carried over into company A in some proportion amount. Ownership percentages, security prices, a stock split, for example. A stock split is going to take a $500 stock and maybe make that a $50 stock. Now, to account for that, you're going to have more shares at $50 than you had at 500. So all of these things go into changing the value of the shareholders' portfolio. Therefore, it would make sense that an option uh, buyer or seller, that their portfolio would be impacted as well. Um, the impact of that is going to be these adjustments that OCC would make where warranted, and those adjustments would mimic treatment of the shareholder as close as we can. Um, let's go ahead and get into how do we know that there's been a corporate action and where do we look for information. So on our website, theocc.com, that's theocc.com, if there is a corporate action that warrants an adjustment, the details of that adjustment will appear on our website under the information memos section. If the contract is to be adjusted, several of the features of that contract, the aspects of that contract may change, and those aspects include the quantity of contracts. So, for example, if there's a stock split, it may reduce the share price, but increase the number of shares that a shareholder has. Same thing with options. The as the stock price goes down, the number of shares, or I should say, the number of contracts that you as a option buyer or seller have in your possession, those would proportionally increase as well. The trading symbol, this one's important. You see here OICX versus OICX1. Anytime that there is a numerical suffix at the end of a trading symbol, it tells us that that option, that contract, is an adjusted contract. Non-standard, you may have heard. A standard option is an option that calls for the receipt or delivery of 100 shares of stock. And then let's stick with equities and ETFs, because corporate actions typically don't apply to index options. The trading symbol. So if you have a numerical suffix, a 1, for example, at the end of the trading symbol, it tells us that the deliverable in that contract is something other than the standard 100 shares. So a reverse stock split, for example, a merger, a dividend payment, something like that, may result in an adjusted deliverable, and therefore you would see the trading symbol change, in this case from OICX to OICX1. Remember, that numerical suffix tells us that the contract is something other than the standard 100 share deliverable.